Welcome to The Explainer. Today, we are diving headfirst into one of the biggest questions in all of finance, something every single investor has to think about. So, let's just get right to it. Can you actually consistently outperform the market? I mean, is it a game of skill where the smartest person wins? Is it just pure luck, or is there something else going on entirely? The answer, or at least the beginning of an answer, lies in this really powerful idea called market efficiency. And here's how we're going to tackle this. We're going to build the whole idea from the ground up, starting with what market efficiency even means. Then we'll look at how it applies to real-world strategies. And finally, we'll explore where the theory, well, where it might not tell the whole story.
All right, first up, the big idea. This concept pretty much shapes everything we think about when it comes to investing.
So an efficient market, what is it? The key thing to get here is that in a truly efficient market, there are no hidden gems. There are no easy secrets left to find. Why? Because the price you see for a stock right now is the best possible guess of its true value given everything we know. Any new piece of info, like a big company announcement, gets baked into that price almost instantly. The secret's already out, so to speak. Okay, this is where it gets really interesting. The difference between these two ideas, market value and intrinsic value, that gap is basically the entire playground for active investors. Their whole game is to find stocks where they think the market value is wrong and their estimate of the true value is right. Market value is the easy one, right? It's just the price. It's that number you see scrolling across the bottom of the screen on the news. If you wanted to buy a share this very second, that's what you'd pay. It's simply where buyers and sellers happen to agree. Intrinsic value, though, that's a whole different beast. You can think of it as what a stock should be worth if you were a fortune teller and could perfectly see all its future profits. Of course, nobody can do that, so analysts spend their entire careers trying to estimate this number. But, and this is a big but, it's always just an estimate. Believing your estimate is better than the collective wisdom of the entire market, well, that's what active investing is all about. And this is a super important point. Efficiency isn't just an on or off switch. It's more like a dimmer switch. It exists on a spectrum. A market like the New York Stock Exchange, with millions of traders, news breaking every second, and super low trading costs, is going to be way, way more efficient than, say, a tiny, obscure market for rare art. It just makes sense. Okay, so now that we've got the basic idea, let's get a little more specific. Academics have actually broken down market efficiency into 3 different levels, or forms, and it all depends on what kind of information is already baked into the price. This little table here is basically our roadmap for the next few minutes. It's a great summary. You can see how each level builds on the one before it. It's kind of like a set of Russian nesting dolls. Each one contains the others. So let's start at the bottom with weak form efficiency. This is level 1. It basically says that looking at old price charts can't give you an edge. All those squiggly lines and historical patterns you see people analyzing, this theory says that information is already old news and fully baked into today's price. Next, we take it up a notch to semi-strong form efficiency, and this is a much higher bar to clear. This says that all public information, we're talking news articles, company earnings reports, economic data, you name it, is already reflected in the stock's price. So by the time you read about it, it's already too late to profit from it. And finally, we have the ultimate theoretical extreme, strong form efficiency. This version says that all information, period, even secret private info that a CEO knows but hasn't told anyone, is somehow already in the price. Now, most everyone agrees that real-world markets don't actually get to this level. In fact, this is exactly why insider trading is illegal. So, okay, with those 3 levels in mind, what does this actually mean for how people try to invest their money? What does it mean for your strategy? All right, let's start with a really popular one, technical analysis. You've seen it, traders looking for patterns like head and shoulders or double bottoms in stock charts, trying to predict where the price will go next. But does the theory say this can work? Well, if you believe that markets are even just weak form efficient, the lowest level, then the answer is no. Using technical analysis is kind of like trying to drive a car by looking only in the rearview mirror. All that past price info is already reflected in where you are now, so those old patterns can't consistently tell you where you're going next. Okay, so what about the other big strategy, fundamental analysis? This is where you do a deep dive into a company's financial health, its earnings, its debt, its management team, all to figure out what it's really worth.
Now, here's the fascinating twist. The work that all these fundamental analysts do, that's the very thing that makes the market so efficient. They're all competing to find an edge. But because it's such a crowded field with thousands of really smart people looking at the exact same public data, it becomes incredibly hard for any one person to find something that everyone else has missed. And here's a perfect real-world example of a semi-strong market in action. Just look at how fast Tesla's stock price reacted to each of these events. The earnings report comes out, boom, the price adjusts. The tweet hits the internet, boom, the price adjusts again. The deal is called off, and boom, the price adjusts immediately. The market didn't sit around and wait. It processed the news and repriced the stock almost instantly. Okay, so up to this point, it sounds like the market is this perfect, rational information processing machine. But as anyone who's actually invested knows, it doesn't always feel that way, does it? So is the theory really perfect? Well, researchers have found these weird, persistent patterns that they call anomalies. They're kind of like glitches in the matrix. They're patterns that seem to contradict the idea of a perfectly efficient market. Things that, for a while at least, don't have a clear explanation based on just risk or new information. So what could possibly be causing these glitches? The leading theory is, well, it's us. It's people. This is where a whole field called behavioral finance comes in. It argues that markets aren't run by perfectly logical robots. They're run by humans, with all of our weird psychological quirks and biases. And here are some of the biggest culprits. Loss aversion. That feeling where losing $100 hurts way more than finding $100 feels good. Herding, where everyone just follows the crowd, creating bubbles and crashes. And good old overconfidence, where we all think we're better than average drivers or investors. These very human tendencies can cause the market to overreact or underreact, creating the exact anomalies we just saw. And that, right there, is the billion-dollar question that brings us full circle. Is the market an incredibly efficient machine that processes information perfectly? Or is it just a messy reflection of our own collective and sometimes irrational human psychology? The real answer is probably somewhere in the middle. And honestly, trying to figure out that puzzle is what makes investing so endlessly challenging and fascinating.